Everyone, this is Andy O'Fee, the Yankee closer. Today is Monday, January the 9th, 2017, and we're going to kick this week off with a 2017 forecast as far as rates go, as far as the housing market goes, as well as what the Fed potentially is going to be doing, and also talking about some of the moves that the administration is going to possibly do going into next year. Stick with me. This is not a 2-minute video. It's going to be 8 or 12 minutes, but there's going to be some really awesome data in here that I know you can use to have conversations with your clients and once again set you head and shoulders above the rest of the competition. So let's go ahead and take a look at our slide presentation here this morning as we get things going. So we've got our 2017 forecast presented by me, the Yankee closer. By the way, if you're a broker out there and would like me to come in and make this presentation to your office, I'd love to do that. Again, there's some really fun things on here, and I really enjoy this. So in 2016, our predictions for the yield on the Treasury, on the 10-year Treasury, was going to drop below 2%. And as I'm sure a lot of you recall, back in the middle of the summer in July, we hit 1.325, which was almost rock bottom back on July 6th. And if you can remember, rates also followed suit. And we all had a great opportunity back then to lock people in at historically low rates, locking people in at 3.25 on a 30-year mortgage. It was absolutely phenomenal. Forecasted home appreciation also, we called for a rate increase, of 5 to 6%. Nationally, we're actually up 6.2%. And the state of Tennessee also saw a healthy rise also as far as home appreciation. Now, the stock market, we actually missed on this call. We were looking for stocks to kind of fluctuate and maybe even drop. We call for the S&P to drop 300 points year over year. Back at the beginning of the year, it did fall, but by the end of the year, stocks were up big. And as we go into this year, everyone's looking for them to hit 20,000. They were the biggest surprise of the year. And then finally, we called for the Fed to make one rate hike. They made a rate hike at the end of 2015, and lo and behold, they made one rate hike going into the end of the year back in 2016, so we were right on target with that forecast. In 2017, the dynamics are pretty clear. We have to look at the Trump administration and what they are going to be doing. They are going to be looking at corporate tax reform. There's going to be talk about slower regulatory issues. And the big thing we're going to get into down the road is the infrastructure. What is the administration going to be doing as far as rebuilding the infrastructure of our economy and our country? The big thing that I always think is very important is inflation. I tell people all the time, two things that drive the market: you have inflation and you have the economy. Right now, inflation for the most part has been very tame, but as of Friday's employment number, we did see wages starting to increase. So again, those numbers are going to come back and they could start heating up the inflationary fears as we move forward. Home inventories remain extremely low. As I'm sure you know, in the real estate community here locally, there's not a lot of supply. So we have got to keep our eye on that going forward. And that should buoy prices and potentially push them higher. Rates. Let's talk about interest rates. Right now, we're starting to see at the beginning of the year rates starting to modestly rise. And my call for the year is for them to ultimately get closer to 5%. Now, I don't see them jumping there dramatically in the next 3 months. But we've got to keep our eye on it as they go higher. We've got to monitor that and keep our clients fully aware of that situation. Remember the saying, rates go higher faster and lower slower. And I think that's going to be the scenario as we get into this year. Manufacturing sector in the United States is still at a pacing at a very, very lackluster rate. We are basically a service economy right now. So we've got to keep our eyes to see how things are going on the industrial side of the United States as far as productivity goes. And the Fed has already made mention that they're looking at raising 3 times as they go throughout this year. We're going to comment about that as we go forward. So let's take a look at the stock market. That's one of the biggest things that everyone has their eyes on. Wow, are we going to get to $20,000? Well, they are at the top right now. They have had an incredible run for the past 3 to 4 months. And right now, we're entering an extremely volatile period where you could see the stock market pull back 1,000 points in the blink of an eye. So we've got to keep our eye on that. A lot of people are funneling their money into that. So my question is where's the rest of the money going to be going if they pull out? So stocks will ultimately get over 20,000, which is my prediction. However, we could potentially see them break down lower through 20,000. And if you'll notice here, when the Dow does break above a point, either 1,000 or 10,000, it takes some significant time for them to pull back and get back over to that threshold. I'm not saying ultimately this is going to happen, but it's just something that we really need to keep our eyes on. Okay, let's take a look at the Fed also. Since 2016, we've had 5 doves in the Fed, meaning doves less than likely to go ahead and raise rates. You've had people 2 in the middle and then 3 hawks. Ultimately, that was the stance that they took last year, 1 rate hike. Let's see what happens in 2017. Well, now you've only got 1 hawk, and here's a little trivia for you. Philly Fed President Patrick Harker, he was the former president, yes, of the University of Delaware. He is a fighting blue hen. Now he is a hawk. So we've got 5 doves, 4 centrists, and 1 hawk in the Fed voting committee. So again, I think it's going to be extremely difficult for them to push 3 times this year unless we see the economy really start to take off. Okay, so the Fed is going to forecast to raise three times. Many economists are predicting that there will be 4. With the new composition, like we just went through, I think it's going to be very, very difficult for them to pull the trigger 3 or 4 times. And I'm calling for the Fed to raise at least 1 or 2 times. More than likely, they'll pull the trigger at the end of the first quarter and see how things go. And then we'll probably do something once again at the end of the year. Good thing to keep your eyes on as we go forward, because again, that could impact rates, and it did short term back in December when they raised. Okay, the housing market. We talked about low inventories. Well, inventories are extremely low. We've got delinquency rates dropping considerably. Foreclosures are coming down. The quality of loans that are getting done are really, really pretty incredible right now. So inventories will be a challenge as we go forward, particularly in the Shelby County area with builders really struggling, and the supply dynamic on for new construction is low. So as you can admit, if you're out there looking for a house in Germantown and Collierville, if you're not writing a full price offer or then some, you're ultimately not going to be writing a contract. This is pretty interesting now. Rents are rising at a clip of 4% per year. That's absolutely incredible. If you're renting a house right now or apartment at $1,500 a month with an annual appreciation of 4%, in 7 years, that's going to equate to $2,000 a month. Renting, again, for some people is convenient, but for the most part, people that rent, they may have not taken an opportunity to take a look at where the housing market is and just how great an opportunity it is to purchase something and make it an investment. Again, let's talk about rates. We talked about rates slightly rising. I don't think they're going to jump high enough where people are going to be really concerned. What I would be concerned about is the fact that those people that were out there that were depending on refinances to fuel their business, well, that business is going to dry up 30 to 40%, and you're going to start to see some of these online brokers and lenders come out of the woodwork trying to dive into your pocket, the local real estate agent, to get them to refer clients to them for purchases. Keep your eyes and ears open on them, again, because the refi market is going to slow down significantly. Incomes rising at a pace easily to support the appreciation. Well, everyone's concerned, and the press continues to say that home prices are on fire. They're going too high, too fast, and the traditional first-time home buyer is not going to be able to support that price appreciation. Well, I disagree with that. Even though home prices are appreciating, people are making more money. So that appreciation, combined with higher interest rates, will be offset by higher incomes. And as we all know, demand remains extremely strong. First-time home buyers are starting to come out of the woodwork. And as we go back, let's talk about the word millennials again. They may not be the fastest buyers, but right now we're starting to see a lot of them come out of the renting market and get into the buyer's market. Millennials are slower to buy, they're slower to get married, and they're also slower to have kids. But right now we're starting to see that start to pick up here, particularly in our area. So my prediction right now for the housing market is for homes to appreciate anywhere between 5 to 5.5% across the United States, and potentially 3 to 3.5% here locally. So good news for the housing market. Okay, let's look at rates real quick. Inflation is the main driver, inflation in the economy. And inflation right now is on target. We're looking at higher wages, and the Fed, that's the number that they're going to be looking at, the PCE number, which they're going to be analyzing on a monthly basis to see when and if they're going to jack short-term rates. I don't see rates moving that much higher, but they will ultimately move between 4.5% to 5%. as we go into the end of the year. Global yields are starting to see pressure. We started to see that in Asia when they went from a negative interest rate scenario back to a positive rate. Well, our rates went higher. The same thing happened in England too. So we're starting to see global pressures across our economy and being funneled into the U.S. Treasury market where yields are starting to go higher. Now let's talk about infrastructure. Well, Donald Trump and his presidency, they're thinking about rebuilding a large portion of this country. Well, where are they going to raise that money from? Well, they're going to have to sell U.S. debt. And when that debt hits the market, that's a ton of supply. That's also going to put a lot of pressure on yields and also be a negative for our interest rates. The 10-year note ultimately right now, I could see the market pull back from 238, which is kind of where we're sitting right now. Maybe we get a pullback to 2.25, but after we get that, if stocks rebound, we could start seeing the slow grind higher and we could get to 3% by year end. Let's keep our eyes on that too, and you will, because I'll be analyzing that on a daily basis. So I'd like to thank everybody again. This has been it's been a great year. I hope you are going to use my forecast for 2017 with your clients. Again, if you're interested, I can come in. We could sit down in front of your office, go over the same PowerPoint presentation. And if you have questions while I've been doing this, or again, you want to shoot me a quick email or a Facebook post, please don't hesitate to do that. This is Andy O'Fee, the Yankee Closer. I hope everyone has a fantastic year, and let's get 2017 off to a running start. Thank you so much.